Yes, thanks for joining us. So the session today is on property development for builders. Well, anyone really that's in building construction and looking to use that knowledge that they've built in the industry to start taking on their own developments or increase that property development activity. Our agenda today, we're going to bring in Dan, who is head of CFO advisory. I'll do an introduction to him in a sec, but he's going to talk about some of the key kind of fundamentals that you've got to have in place across your business from a commercial perspective before you want to start taking on property development. Because I mean, it's hard enough being a contractor, a builder, and doing your own project, doing projects for clients, I should say, but then starting to bring your own projects into the mix as well. The complexity goes up even further. So we're going to talk through some of those key ingredients you need to have in place from the get-go. We're going to then talk through construction around your own projects, but do that through a couple of different scenarios. So some joint venture scenarios where you may be involving other parties as part of the development. And then we'll talk through doing your own development. So really, which is where you're controlling all aspects of it. So we're going to use those two scenarios as the lens that we're going to unpack this through today. And we're going to consider things from a tax and structuring perspective. So, obviously, those two things will have a massive impact on how you come out the other side of the project in terms of retained earnings, profits, etc. And then we're also going to talk through the funding of profits of projects as well. A big reason why we have our friends over from the NAB on the session today. They're also going to do a quick update for us as well at the end on equipment financing. They've got a bit of content to share on that topic, also very relevant. We've got just a couple of polls along the way, so we'll do that. And we have we're going to take questions as well. Drop your questions into the chat as we go. There's some natural kind of breaks as we go through the session where we can answer those questions, but we might just answer them in the chat as well. Remember, we always say this, there is no such thing as a silly question. This is a safe room. You can ask whatever you want. Hopefully it's related to property development though. But yeah, please feel free to ask whatever you want. This is the right opportunity to learn. We have an ebook coming soon on this topic as well, so we'll be sharing that over the next week or so. We will be sharing the video from this session at the end of today. Hopefully we'll turn it around. If it's not today, it'll be tomorrow. So you'll be able to watch this back again. And any of the resources that we talk about today as well, we'll share in that email when we send the video. So today's presenters, we have Josh, who is one of our partners at Xact Accounting. He is a partner in our compliance or tax and structuring division, has been with the firm for 5 years now, really deep understanding of building construction. QBCC superpower as well, really understands that space for our Queensland viewers today. But yes, very deep in the world of helping property developers and builders understand their tax and structuring affairs. Dan Wilkinson is our partner and head of CFO advisory. And so Dan is going to be talking to the commercial aspects of property development today. Julie and Gus are here from NAB. Welcome to you guys. NAB, we're very happy to say, have signaled that this industry is something they're very, very interested in and want to really look at different ways of supporting growth in the industry. And so we're really privileged to have you guys on board today. Thank you for joining us. Okay, I'll just quickly give you a rundown of what we do. I'm sure some people have heard this before, but we have 3 separate divisions. We have a bookkeeping division, which is these days about system integration, making sure you've got the right software stack in play and that all of those pieces are talking to each other. So at a transactional level, you can track costs and really make sure that you've got good, clean data in your world. I've already talked about compliance and Josh is a partner in that team, but very much about tax structuring and all of the various licensing regimes that we have around the country that obviously have a financial component to them these days as well. So we understand that space really well. And then Dan from CFO Advisory, this is a fractional CFO service. We find that businesses and building and construction get to the point where they might have good bookkeeping in play, but they need more than that as they grow. And so the CFO Advisory team offer a fractional service. It's like a monthly fee, and you get access to your own CFO and a team of management accountants on a essentially like a part-time fractional basis to get better visibility and drive margins. So that's what we're about. I might throw over to you guys, Gus and Julie, if you want to just quickly talk through what you're about and the services you offer, that would be great.
Yeah, excellent. Thank
and welcome.
you. And we're going through a major pollen season here in Brisbane at the moment, so just ignore my voice. It's very high allergy season at the moment. So I'm Julie and Gus. So we're from Commercial Bank in Brisbane. So we ultimately look after commercial lending from about 1 mil up to 50 mil. We also work with our small business colleagues, and then after that, it sort of moves into emerging corporate. So we look after trading businesses. Construction development is a big part of our portfolios, especially Gus. He has a lot of builders and developers that he works with. So we're very much open to working with people within the industry. I know that Phil has said that people have struggled to get finance and things in the past. So we just want to say that we are here to support you. Just to give you an insight into the complexity of what Gus and I work with. So people sort of see Gus and I and think that we work solo, but we've got so many specialists behind the scenes that we work with, and we all work towards helping the client at the end of the day. So we've got Gus and myself are the business bankers, but with us, we've got home lending specialist, trade and invoice finance specialist, transactional banking specialist, foreign exchange, equipment finance, markets, and also private wealth. So at the end of the journey, when you want to sell the business and you're not sure what to do, obviously, we've got the private guys at the end of the journey who can jump in and help as well. So we've got a lot of support, and all of this support is given to Gus and I to help our clients. We also have relationship associates who are basically office-based who can help with our clients' day-by-day questions with accounts and things like that. So they, if you need to open up new accounts, it's urgent, they're in the office, and then they support Gus and I. So we do have a lot of support within our teams. So anything else to add, Gus?
I suppose the main thing is the same way with the Xact team, have they explained that they've got multiple facets to their business. What Julie and I do and what we do with partnering with firms like Xact is that full relationship model. So you think of the accountant, your solicitor, your banker in the middle of that wheel, and all these spokes that come out of it. And to help you move your business forward, it has to be a harmonious relationship. And that's what we're here to do.
Yeah, it's great. So it's not just that one piece of work that's going on. You guys own that relationship, and then you bring, various services from within your business to come into play as required.
I think what's changed in banking over a number of the years, I know a lot of the clients that are on the webinar today would have been in business for a number of years and potentially some only in recent times. Banking has sometimes been felt from a customer's perspective that it's become more decentralized and it's hard to find a person. There's a lot of self-service options. And look, they're fantastic because the customers that access those products need them from a speed perspective. But the people that we're all looking to deal with and those that are on the webinar today, there is a relationship option. And that's what Julie and I are. We're your relationship managers. We're responsible for moving your business forward with the partners that you choose to use and work with. And that's the biggest difference for us. We've got a specialization in construction. As Julie mentioned, myself personally come from a family of builders and property development. So I've got a special affinity for it. I like being able to drive past and saying, to my wife, my customer built this, or they're actually doing the road over here. They did the civil works over there. We take a lot of pride in that. So we're looking forward to giving you a little bit more insight on how we do that later in the session.
Awesome. Okay. Thanks. Thanks, guys. So we'll move on here. So before we begin, this is a disclaimer to say that we're just going to give you some general information that we hope is very useful for you today, and that you can take back to the business. But please, before you make any decisions, make sure you consult your trusted advisors, whether they're accountants, lawyers, etc., before you make any decisions based on anything you've heard today. We're going to run a quick poll. We would love to know where everyone is at in this property development journey. So we've got a few options here. Starting with, I've done a few renos on my own house as a pretty entry-level property development piece. About to have a crack at my first development. Have been doing small developments for a while, so splitters and flippers and things like that. Getting pretty serious. So sort of around 50% of the income coming into your group is now coming from property development. And then we've got full-time developers as well. So whenever we do these, we like to kind of just at the beginning get a bit of a feel for what the audience is at, where they're at and where they're coming from. And so we can see it's mostly, I'll just end that now. We've got almost everyone has contributed now, which is great. The more the merrier. This is anonymous polls as well, by the way, so don't worry about that. But it's interesting to see where everyone's at. So I'll just share those results. So we've got sort of, it's mostly at the earlier stage of the process where people are at. So about to have a crack at first development and having done some small developments, so 32% in that part of the world, and a few starting to get more serious. So that's sort of about right, I would have thought, in terms of people joining this kind of webinar and really starting to understand what's required to do property development well. So let's move on. I'm going to bring Dan in now, Dan, and he's going to help set the scene for us in terms of what are the core commercial ingredients that you need to have in place if you do want to take on more development work and make sure that you can grow profit sustainably from that activity. Dan, over to you. I'll stop sharing and you can take over.
I've already jumped on Phil. Thank you, mate.
Good on you, mate.
Can you see that all right?
Got it perfectly, yep.
All right. Yeah, good morning, everyone. Thanks for making a bit of time this morning to jump onto the webinar. And again, please shoot through questions. I definitely make the most of the time and the brain power we have either on the chats or here. Yeah, so please shoot them through. I'll push through my section pretty quickly. Josh and Nav are obviously the star of the show, but I just want to just instill some staples into what we're going to talk about now. So what we'll jump into first is what you're looking at here is the standard residential model for building. So the principles are the same, whether or not you're sort of turning $1 million or $100 million. It'll change a little bit depending on whether you're in civil or industrial, commercial, et cetera, et cetera. But in this example here, we have $1 million of revenue coming in. You'll typically spend about 80% of your money on COGS, so 80 cents on the dollar. So that's your earners, people, trades, site managers, et cetera, and then out of that, you'll spend 10 cents on overheads, ideally 8 cents, and then you're left with 10% net profit at the end before tax, obviously. And then this is our standard model in the building construction game when you are building for other people in the background. But when you sort of reach a certain age and stage in business, I'm sort of finding more and more clients going, well, how about we have a crack at this ourselves? Like there's more money to be made. Australia's obviously supply of houses is low and demand's high, so there is money to be made out there with the right support and sophistication behind you too. So then we go, well, what does a developer builder look like? So what you're looking at here is that inside that first bar graph at the top, that is your typical residential building business where you are trading with other clients. So they'll come to you, or an architect will come to you, you'll build your house, there's your 10% net profit. Now, when you are looking to internalize it, so you are the builder and then obviously turning into the developer, or you might partner up with someone with land. And this is just in theory overall. So when you do look at the opportunity, especially if you are good at swinging the hammer, and then obviously if you dot the I's and cross the T's and you are sophisticated in your feasibility around buying, building, acquiring the land, JV, whatever it is, and selling, there is the opportunity to make a lot more money too. So in this sort of standard build here, you'd be looking at making 10 cents on the dollar. So $1 million build, you make 100K. But when you fold this over the top of a development project, and this is just for demonstration purposes only, the exit on that sell, if you were the developer, would be around about 400K on a $2.4 million build. And again, this flexes up and down overall. But the beautiful bit about this is that if you have the right business systems in place, you know how to build, swing the hammer, you're good at it, you get the opportunity to what I call internalize that margin. So instead of being the developer and paying another builder to do it, and then you obviously pay them the margin, you have a bit of a double bite of the cherry, which is chomping in that net profit of 400K and then chomping in that profit of $100,000. But it's a different ball game to your standard building. Obviously, there's market forces and the right time, right place. But you have to act like a sophisticated business owner to really get this right. So it's not scary. It's just like any other business venture. You've done it before, but it is a different ball game, which is why we're on the call today. So I don't need any more clients. Now, there is a romance with doing your own developments, and I have chats with clients and potential clients all the time. They go, look, I'm tired of the resi game, the emotion. I want to go build my own full-time. Can I do it? So, Dan, exactly, you're telling me that I don't need clients anymore. Well, at the start, the answer is no. So particularly when you're going for financing with banks or you are rattling the tin to do your own development, I mean, you really need to make sure the income producing asset number one is secure. You have to make sure that you have enough builds in the pipeline, you have enough starts on the go, the right people, it's systematic, it's spitting out money, because unless you're sitting on a pile of cash or a decent inheritance, in which case you probably wouldn't be on the webinar, you need to make sure that there is some decent income coming in. So it might be 3 for other people and then 1 for yourself, or 4 for other people and 2 for yourself, whatever the cadence happens to be. So whether or not you're sort of starting off, I guess, in your building construction business, you're going out to developments, I mean, the cores that are in your core business, i.e. building, resi, or commercial industrial, these 5 items here are non-negotiable. So you have to make sure your bookkeeping is absolutely immaculate. His bookkeeping isn't, I guess, like the partner's responsibility or, the person that's working remotely. Like, bookkeeping is absolutely your responsibility. And I can't stress how important that role is as far as getting good data in, good job costing, et cetera, which leads into the next part. So all the costs that are sitting up in COGS have to be allocated to a job. There are certain circumstances which it isn't quite one size fits all, but that job costing piece is also critical. Given that builders' margins are so small, like compared to like lawyers or doctors or anything like that, I mean, you can leave a lot of money behind if you don't have that job costing piece in place. So you're learning and developing, not just from how to, I guess, get better at the estimating process you have in place, but how do you stick the landing and make sure you make the money you are hoping to make. Work in progress is also super critical. So if you're not doing monthly WIP, your profit's going to bounce around like a yo-yo. So again, I can't stress how important that is for financial clarity, because if you micromeasure profit, cash is a byproduct, 98 times out of 100 work out, touch wood. You also need a really good budget in place. So if you are layering in this development piece, your sort of standard, I guess, budget for residential building can get pretty wobbly, because you do need to reserve a fair amount of cash for the development, for the fees even to sort of stack up, and obviously for NAB to give you some money as well. So you need a budget which is a scorecard, right? And it's a rock star budget: starts, people, timing, crew sizing, resourcing, cash, et cetera. And then probably the most important piece, if you are, I guess, going into developments heavily, is you really, really, really need that A-grade team in place as well. So this bit is critical. So when you have the A-grade team, I'm talking about a strong right-hand person for you as the owner. You have to have a really good bookkeeper in place. And then the other thing I just want to talk about too is, if you're about to jump into developments, or say you're scaling up really quickly from 3 to 5 to 10 to 50, whatever it is, and your bookkeeper is your key finance person, it just won't fly. You will absolutely run into problems. And look, you really need some C-level, I guess, some C-suite level support in the business to give you a hand. So someone that has some real commercial firepower. So someone who has been working as a CFO, and they have a completely different skill set to bookkeeping and even tax, obviously, with the utmost respect. Josh, you sort of pick your player for the role, and you need a really strong commercial right-hand man. So if you're looking for someone like me in the market, and again, you are looking for that sort of commercial right-hand person, and you don't want to rock in the corner or figure it out late at night as to how to make this FISO work or scale the business, you can hire someone like me full-time, so on the salary, but they'll cost you 300 to 400K every day of the week for a good one, and you'll have to sink that money in for a good one. You don't want someone that's, C grade at best. I guess the other thing I just wanted to impart with you too is, as you grow bigger and the like, you can have access to that sort of talent on a fractional basis. So there is a bit of a selfish plug in here, but you can get access to that sort of firepower and support for a fraction of the cost, obviously, as well. So the philosophy behind this is that you have to make sure you have the stables in place, which is everything on the screen here. Make sure you have a really good budget in place, particularly a cash flow. And obviously you have the right people in the right roles to really take a bite of that cherry and obviously evolve the business going forwards. Because the business model you're probably running at now, if you do push into developments, will definitely make you come unstuck unless you have the right people and structure in place. And obviously,
I just wanted to add on the back of what Daniel's saying here. The thing is that his services and the thing that his team offers actually will free you up with the ability to focus on the project you're doing, especially if it's one of the first ones that you're doing. You want to make sure that your existing business is going to tick along and continue running. So having that in place before you do your first development not only shows the bankers like Julie and myself that you've actually thought about the transaction, you've got the right stakeholders to support you, but it will also make sure that your feasibility and the margins that you're hoping to achieve are actually going to be attainable, so you can solely focus on them as well.
Yeah, yeah, and I guess we provide those services, but really what we're advocating here is that you have someone in your business in some capacity that can be your real go-to. If you don't have a strong sort of financial acumen and experience behind you, and really, bookkeeping is about your only access to accounting, then you really need to start to look at what's my commercial accounting acumen in the business, and who can I bring in either as someone that I employ or that I can get someone in as an outside resource from an outsource perspective. Dan, we might, if there are any questions around that, just drop them in. We haven't had any so far. So what we might do, just to kind of keep things moving, we might bring you in now, Josh. We will sort of hang around at the end as well for further conversation and questions. So if you think of something and you want to ask it later on, then we can answer it then. But I think for now, Josh, we might bring you in if you want to jump off mute, and we'll get you into play here. 2 seconds. Here he comes.
2 secs. We've got a bit of a lag here, guys. Okay, we're good. So we're sort of touching on the 3 pillars, and I want to sort of go through my side, which is really that tax and structuring, because Dan and Gus are 100% right, but you need to have the right people on the bus here, because what we're saying is to do this properly, you actually do need to walk and chew gum, and it means we need 3 pillars to work together: commercials, financing, but also structuring and tax. We need to make sure that all this effort we're going in is protected, and we actually get to keep more cents in the dollar at the back end of it all. So what we want to work through initially is, like with anything in business, we need to start with the end in mind. So we just need to understand how we're putting this together, who's involved, and how we're going to protect everyone's interests and get the best outcome in the project. So the 2 sort of main examples that Phil covered off on in the early pieces, we'll sort of look at how joint ventures work, which is really where you're bringing multi-parties together, as well as if you're going into your own projects as a full sort of developer group in parallel with your building company. We'll look at those 2 as well. As Phil disclaimed early in the piece, there's no one-size-fits-all in terms of structuring. There is that many different versions of structures that we come across, and I'm sure Gus and Julie have seen some interesting ones as well on how we actually pull these projects together, particularly when there's multi-party. So I'll unpack this structure in a bit later on, but here's one example with the sort of joint ventures. So the joint ventures are a very common structure to be using. So let's just sort of rip through why we actually use joint ventures. The key one, very obvious one, is we're just trying to bring sort of pooling resources, skills, capital together, as well as sharing a bit of the risk of these projects as we go along. And usually joint ventures are sort of a function that are used to do a bigger development as well, just because it might not be so possible for everyone to just go and buy all of the land and then do the development, right? So the most typical joint venture is a land person and someone who actually wants to do something interesting with it, i.e. build a structure on it and then realize a project. Now, the structuring, that can be done so many different ways, but some of the examples are using sort of company company structure, which is sort of well understood entities. If you've got multiple parties involved, you might have things like unit trusts. And at its sort of most pure form of joint venture, it's kind of like a partnership, and the weight behind it is using good legal documents. So in terms of how do we get capital for a joint venture, again, this is sort of depends on what you're trying to achieve, what capital you can put in up front, and who's involved. So you might have shareholders and lenders within the group being able to put the capital forward. We then could be working with the likes of Gus and Julie and their teams to work out whether we can get funding from a bank to do it. And obviously, as Gus sort of alluded to before, there are some of those other self-serve ones like your second tiers and private funders as well that might come to the party, and they all have their place as well. In terms of risk, we do need to make sure when you've got multi-parties, like with anything, whilst you're all on good terms right now, things can change, things can not always go to plan. So we do need to make sure we're managing things around conflicts, decision-making. We just need to make sure things aren't set up badly or not even thought of up front. So we do need to make sure that we're mitigating risk and being clear up front with our joint venture partners of what's going on with cost overrun and project delays. And taxation, the key things, and we'll talk about this in a second. We'll talk about the GST income tax and how that works through these sort of structures. Sort of depends. And don't forget, each state has their own bite as well in terms of land tax, because land tax is a very real thing to consider as part of projects, particularly when they're multi-year running projects. Now, we want to go into do some first principles tax. Now, I don't want to make this a tax training webinar. So we do just want to get through here, but we just want to plant the seed and just bring it to front of mind that there are some tax areas that need to be front of mind when going into property development. Don't think of it as an afterthought later on to go, we'll deal with the tax later. That's just not the appropriate way to do it, because it can cost you hundreds of thousands if you get this wrong, that you can't change. So the key one we're talking about is the capital gains tax regime, and really all the capital gains tax is a bit of a misconception. It's not its own tax. It doesn't sort of have its own tax system behind it. It's just a carve out for tax that's specifically applied to sort of holding of assets. And in this case, we'll talk specifically in property. So property by default falls into the capital gains tax regime, unless sort of exemptions or some other application applies, like property development. So basically any asset acquired after 1985, like property, will fall into this net. Now, everyone will know, and I won't harp on about the main residence exemption. The key thing is the main residence. Everyone knows we shouldn't be paying tax on the main residence. That's a complex area in itself, and it does require some very careful planning because the tax law is quite complex there. But I just want to remind everyone that your home is actually subject to capital gains tax. It's just that it gets the ability to have an exemption applied to it, right? So don't assume that the home isn't subject to CGT, because it actually is. It just has a carve out. Now, the CGT discount, just quickly, usually holding investments as an individual or via a trust structure. You hold it for longer than 12 months. We'll talk about property, investment properties, and you sell it and make a gain. The tax law allows you to discount half the gain, or 50% discount. So 50% of the gain is tax-free. And so that can be quite a useful tool if you're doing an investment holding sort of portfolio. But we're going to talk more around less holding investments and more around actually doing property development as more of a business type enterprise. One key reminder now, any transaction with property in Australia now, if you're selling property, the ATO require, and the threshold used to be 750. If you're selling property for 750 or more, you had to get a clearance certificate. This is just a reminder. If you sell any property now for $1, the ATO wants you to do this admin process to make sure that you get this clearance certificate. It takes no time at all to do it, and lawyers and accountants need to be across it. But you need to have this certificate in place before you settle a property. Otherwise, you could have some surprise withholding of tax at settlement, which might throw you a curveball. Now, the actual tax principle that's probably more front of mind and can be hard to actually understand is the GST impact. So I just want to get in front of your mind now that property development and GST exist together. It's something you just need to be aware of around first principles GST. So similar to the capital gains, if you're doing some little renos on your home, etc., and then you subsequently sell it, and of course you need to genuinely show it was your main residence. I'm not saying go buy a property, live in it for 2 weeks, renovate it, sell it, make a gain. Be careful, it doesn't quite work that way. But generally, your main residence, any work you do on your home doesn't have a GST impact. The key thing that we want to sort of highlight here is the property development business. So we're talking on this webinar today about being serious property developers. So rather than thinking about we're sort of flipping one home here, we're actually talking about doing this as a genuine enterprise and a genuine business aside in parallel with your building company. So the whole intention of property development business is to make profit. We're going in there to do a project, make profit out of it, and likely recycle that back into further projects. So that's we want to sort of focus on that part of this. Now, the thing that probably throws people is not appreciated as much is you buy a bit of land and put a house on it and sell it. That for quite a number of years now, the ATO had changed the GST law, and so that new residential property is subject to GST. You need to be very mindful of that when you're doing this, particularly if there's a clear intention that you're doing this to make a profit. So, I'll talk through how we might better sort of limit that GST. Just think new residential builds subject to GST because it's new residential premises. Bit of background of why that came into play is they're sort of looking at property developers, big scale property developers, and just wanted to make sure that we're creating new product and wanted to actually GST tax it. The one that's probably less known in this is substantial renovation. So you've bought a property, we're going to do this as a development, we're going to renovate the property, improve the value and sell it. Now, substantial renovations is a grey area because if you have fairly significantly renovated the property, the ATO's view is that you've pretty much created something like new residential premises, and that's going to be subject to GST. That's a very grey area and requires a lot of planning. So I'm not going to deep dive that because it is very complex, because it doesn't necessarily mean that you had to have removed all the walls and all that sort of stuff. Substantial renovation can be, quite simply refreshing the whole facade of the house is going to be a flag in terms of substantial renovation, of course. Now, the other considerations around GST, I'll just run through these now, is whilst GST applies when you're selling these projects, the key thing is we're doing this as genuine development businesses, right? So any inputs into building the materials, supply, all that sort of stuff that goes into building these projects has GST generally in them. And as a property developer, you'd be claiming the GST credits as you go along, or input tax credits. So you'd expect that there's some GST that you'd be claiming back through the project. Generally, the rental properties is if you're doing a project and ultimately want to hold it as a rental, we just need to understand how the GST will apply around that. And there's some specific rules, particularly if you've created new residential premises and you sort of hold it for 5 years as a rental property and sell it, there may be a different GST outcome / may not be GST at all when you sell it. So you need to be talking to the likes of myself or a tax advisor that actually understands what that means and how you plan that out. So some of this can be quite a long-term play, years in the making. So you need to think about it now. Now, GST margin scheme is what I'm going to unpack now, because it is actually a pretty complex little area to understand, the margin scheme. But the whole premise behind the GST margin scheme is to basically look at how did you buy the property in the first place, and was there GST in it in the first place? Did you actually get the ability to claim GST when you bought the land in the first place? And so if not, basically there is a nice kind carve out in the GST Act that sort of goes, well, we won't penalise you at a GST level because of that. And so I might just walk through this margin scheme example now, because the best thing we can do is look at an example. So say in the left here, no margin scheme applies. And so we bought a property, 1.1 million, wasn't subject to GST when you bought it. So you bought it from a private individual who was just selling their land. You do a project, ultimately sell it for 3.3. If margin scheme didn't apply, you'd have a $300,000 GST bill on sale, right? And this is ignoring, of course, any GST you may have claimed whilst building the project. We'll just talk about the actual sale. So you'd have 300K. Now, if margin scheme does apply, and I will premise that you do need to be careful with your contract, and you do need to talk to tax advisors and lawyers at the time to make sure you do this right, because you have to tick specific boxes in your property contract, as well as make sure you're eligible if you can do it. But again, same example, 1.1 million, bought a private sale. We sold it for 3.3. Now, with margin scheme, what it looks at is goes, well, the 1.1 didn't have GST in it, so you didn't get a GST claim of 100,000 up front when you bought it. So it looks at the margin or the difference between what you bought it for and what you're selling it for. In this case, 2.2. So in this case, with margin scheme applying, you're actually 100 grand better off by appropriately applying the margin scheme, which is a decent amount of money, particularly if you haven't planned for that properly. That can be a bit of a surprise. Now, with the mechanics of the margin scheme, I'll just quickly rip through this as well. That's that same example. So GST is going to apply. Now, in the first instance, what happens when you're selling this property, particularly new residential premises, is because commercial is a bit different, but we'll talk about new residential premises at the moment, is the ATO have required for a number of years now that at settlement, where GST applies, a 7% withholding will apply. And basically, 7% will be sent to the ATO by the buyer and will be sort of parked in a holding account as the developer. Then what you guys need to do is actually calculate the margin scheme calculation properly. So you go and do the calculation around the margin scheme, quantify that 210,000 was GST on the actual project, knowing that at settlement 231,000 was already withheld. So what happens is it goes through the business activity statement system, or your BAS. So it washes through the system. In this particular example, is your actual GST bill was 209, 231 was withheld settlement, so the ATO would give you the refund of the difference back. That's just some quick mechanics. I can talk about that at any other point if you have any questions around it, but that's just a really simple example of how those mechanics work.
Yeah, and we always debate what goes into these webinars, and I know there's a fair bit of content to sort of get your head around there. But our principle is we want to try as much as we can to demystify some of these really important pieces of the puzzle. And some of you on the call today will know that already, and hopefully it's just been a good refresher for you. Others may have really struggled to process that. Watch the video back again, but of course, reach out if you want to talk through any of this any further. But we're really just flagging, here are the key things you need to understand. And so again, talk with your advisors about this stuff, because it could mean, as we've seen in some of these examples, a really big difference in the tax outcome for these projects.
100%. And it's so complex that we don't want to make this a deep tax learning session, because each case will be different. So park those at the sort of front of your mind. So what I want to do is circle back, because we're about to tag Gus in a second, circle back to that structure I was looking at the beginning. So I just want to quickly walk you through sort of an example structure here and things that you sort of think about. So we've got a scenario where we've got sort of a joint venture partner 1 and 2. Joint venture partner 1 is someone who's already a builder and wants to sort of partner up with someone to do a project. And joint venture partner 2 is a landowner in this example. So landowner wants to do something interesting with the land, builder is interested in building a cool project. So what we're doing is we're pulling those two core resources together. Now, in this sort of example, the key thing is, and Gus and Julie will see this a lot, you have to be careful with the landowner. It obviously works very nicely if the landowner owns it outright already, and there's not already leverage to the hilt. If it was already leveraged to the hilt, we might have some funding problems. But in here, what I'm trying to point out is there's sort of some key pillars that you need to put together in these structures. So you can set up the entities, but there's also some really important legal agreements to put in place just to protect everyone's interests and make sure that we're getting what we want out of the project. I've sort of shorthanded this PMA, but project management agreements are very common to be in there, where the builder has an agreement outside their build contract just to manage the project where the landowner isn't already used to doing development. I call this fund through agreement on this sort of bottom left here, which is basically the landowners giving authority to use their land as security to do a project, which is what the bank will need. They'll need the real property of the land as some security for lending. No surprise, you'd have a build contract between sort of the landowner, JV, and the building entity. I say here low margin, which we might unpack a little bit later, because we do need to make sure that we are doing this properly. The build entity also needs to be making the right margin, but there's a bit of a trade-off of not having that build contract too high as a price, and overall the builder wants to be recovering that cost of managing the project. Now, what I might do is at this point, I'm going to tag you in here, Gus and Julie, because the important bit is with anything of these structures, I say, and I'll say this a bit later on in the webinar as well, is it doesn't matter how you structure it. In the first instance, we need to be talking to the likes of Julie and Gus to see if the fund is even going to come to the party in this structure that we're trying to set up. So, Gus, mate, talk through the scenarios of these sort of joint ventures.
All right. So at a high level, the structure and the way that the unit holders come together, all of those sorts of things are really important to have done up front. And predominantly the reason for that is for the bank and our colleagues to actually get on board and support a transaction. We don't want to be chopping and changing the structure halfway through. So that's probably a first gate, is to meet with those individuals that you're going to get advice from on how to set things up to start off with, because I've seen it time and time again where we've gotten all the way to an approval, we've got an urgent settlement date, but it turns out that instead of having a unit trust, we have a discretionary trust. And from an accounting perspective and from the tax outcomes on, starting with the finish in mind at the start, if we were to execute like that, there'd be huge tax implications, and it's caused a whole sort of world of hurt. So it's really important to make sure we get those things done up front. The structure and how the deal gets approved is very different depending on the whole range of circumstances. But Josh is correct. The way that we would love to see the transactions put together is a partnership between the joint venture partners. So using Josh's example, if you want to just go back one slide, Josh, I could just talk to the structure that you've got here. So a joint venture is simply a venture with more than one person that's not related party. So that could be a landowner and the builder. It could be a landowner, the builder that's a residential builder, and then somebody that just specifically does civil works. There's a whole myriad of different options. The reason why they are a good option for a customer and why the bank is comfortable in funding them is that, similar to what we were talking about earlier with having the right advice from the right people, it shows that your project has structured with the right advice. So the person that's the specialist in building the residential dwelling, they're involved, they've got equity in the deal. The person that's going to do the civil works and get all of the subdivision works done, they've got equity, they're a part of the deal. And obviously the landowner is providing the land to get it done. And they've recognized that they don't have the skills to put the nails in the wall, to dig the holes and do the footings. So they're partnering with the other two individuals. So from a comfort perspective, it gives us a high level of comfort that the project's going to get finished. The bank's obviously a risk partner. We're there as a debt funder. But our biggest concern when we look at these projects up front is, are they going to get completed? Because there's nothing worse for all people involved, including the bank, to have a project that isn't finished. It's very difficult for another builder or another developer to want to get involved in something that's only halfway done. From an approval perspective, sort of key metrics that we'd want to look at is a significant amount of equity up front. So a lot of things that we see when it comes to purchasing land, the clients will put a significant amount of capital into it, so cash equity, dollars in the bank, to get a DA approval. Maybe it's a subdivision request. We are more than happy to look at the value uplift. So you might have bought the block for $1 million, but now you've subdivided it into 3 titles potentially, or you've got an approval from the local council to build multiple dwellings. We recognize that there's been some effort in there, and there's also some skill in doing that. So as long as you've held the site for roughly around 12 months, we can look at something shorter, but 12 months is a good yardstick. we're able to rely on the updated valuation value, and that might be a way that you find equity in the transaction. The second part of the joint venture transaction is it reduces the risk on getting the transaction finished. So if you're partnering with a builder that's also invested, when cost overruns ultimately occur because the soil is a different consistency, maybe there was more bedrock than was expected. These unexpected costs are a part of doing business, as you all know. Having people that are all in the transaction together, it provides, one, there's a larger amount of bodies in the deal to wear those costs, and two, you're all working towards a common goal. The funding that we do on these developments is not based on the end value. So you've got what we call the gross realizable value, or maybe your expected sale outcome. There's a lot of different acronyms, but essentially, if you buy it today for $1 million and you put $1 million into it, I'm sure we don't want to sell it for $2 million because we've made no money. So the gross realizable is what you're expecting to sell it at market. And that's where your builder's profit that Daniel was talking about before is significantly greater as a developer, opposed to your builder's margin, your BQM, that you might have as building a third-party transaction. So from a funding perspective, the bank funds a percentage of the total development costs. So what that means is it's the cost that you paid for the land, the cost that you're paying to build the project, so from the builder's contract, put those two together. And we also recognize other soft costs. And that was what I was talking about before with council contributions, paying statutory costs. Maybe it's architectural and civil engineering drawings, all those sorts of things. And we put them together. So it might be $1 million for the land, $1 million for the build, and say 500,000 in soft costs, 2.5 million all up. We will typically lend to a rough percentage of about 70 to 75% of the total development costs. Now, because these situations that we're talking about are all build to sell, there's a couple different ways that the bank can get comfortable, that Julie and I can get comfortable, that we want to go past those policies. So these are just guidelines for us to work within. For some customers, we'll be well below 75%. We won't be comfortable at that. It might be 50 or 60 because they're building a specialized asset. Maybe it's got a bit of NDIS or multi-rooming accommodation under the 1B tenancy laws at the moment that we're seeing a lot of interest in. Or maybe they're building a specialized childcare center, or it might be a service station. So there is a range, but ultimately for us to get comfortable with going past those ranges, pre-sales are really important. So that's a way to show the bank up front that there is marketability for the project. We can talk to real estate agents, they can give us the appraisal, but having a unconditional contract with third-party buyer, a bona fide third party, so that's not your cousin or a mate that you're related to, etc. Certified bona fide third party, it provides the bank with comfort that there is a market for this. Now, when it comes to residential dwellings, we understand that there is a short supply, so we are a little bit more bullish. But typically, we'd want anywhere from, in a perfect world, we'd love for you to tell us it's 100% pre-sold. That would be the best case scenario. And that's where that loan to cost could be maybe extended a little bit further. But we're also aware up front, if you're doing a multi-site project, maybe you're building 2 or 3 houses, the more that you sell, or maybe 10 houses, if you're doing like a townhouse complex, the more you sell up front, the lower sale price that you might achieve, because it's difficult for a first home buyer or maybe an investor to buy a product that isn't completely built. They have to be able to visualize it. So we are comfortable with a smaller amount of pre-sales, but that's definitely a way to mitigate it. The other option in these transactions to reduce the amount of equity you have to put in up front, or potentially not have the entire project pre-sold, is a trading business guarantee. Which is also applicable in these JV structures, because the builder that's building the project, if they've got equity in the deal, they might be comfortable in providing a guarantee from their business to say, well, if it isn't pre-sold, or if there's a couple of other roadblocks that come up, we're happy to use our business cash flow, because we've got an excess of cash, to put towards this project and make loan repayments. So there's a couple different ways that it can be done, but the joint venture structure is something that we see a lot of. It also shows that you've had the foresight to take into control the different types of partners that you need to get the deal done. And it's also a really good one to do for your first development, because it spreads the risk and accountability from an equity of how much you have to put in. And also you've got more people focused on the same goal. And, they always say, many hands make light work. So it's not a bad idea for your first one.
Yeah, and it's like with anything, any business, risk mitigation, just like NAB, you guys have got to, you're willing to be flexible. It's all around risk mitigation as well. And multi-parties clearly gives a bit of confidence as well, because there's not just one person. It's not one person.
Yes,
Simply put.
exactly.
So, because the developments, as we all know, can go off track every now and then because of things you just couldn't possibly predict. So it's good to know, though, Gus, that you guys got that sort of flexibility, and it's no size fits all on structuring or funding. The funding options are nearly endless in terms of the way you put it together.
The early engagement is really
yeah.
critical. Like a lot of our existing customers, sorry guys, a lot of our existing customers that are within my portfolio that are builders and developers, I think the majority of the phone calls I have with them is about, hey, I'm looking at this site. This is what we want to do. What do you think about it? And that's one of the reasons why having a business banker and a partner is really crucial, because you can start to spitball ideas before you go out there and actually have a conversation about it as well.
Yeah, it's this constant sort of flow of information, isn't it? And you can do that when you got a relationship in play. But all of those strands have to come together for it to work. And so you can kind of, as an operator, you can start to de-risk that by having these conversations in play early, and obviously getting the right structures set up and the right parties involved. Okay, we're going to quickly move on now. I think we'll move past questions because we are kind of up against the clock here, and we might do an express version of this next one.
This next one's quite complicated, and this is really what we're getting as multi-project, or you've actually got to a size where you are basically running a building company and a development arm to your overall group. This again, it's an example structure of risk mitigation, as well as being clear with the likes of NAB and funders on how we put this together and how the parties involved. So we can, again, I can unpack this at any point with anyone at another time, but this is really just demonstrating that there are ways to strategically put this together to achieve both wealth creation and risk mitigation. And how we do that is we usually use different entities to spread or segment the risk. Now, multi-project, what is the sort of profile here we're looking at? Is really, we're trying to do all this ourselves without any joint venture parties. We're not reliant on external clients anymore, and I make that point, not reliant on them. So you still need to have them, but you're not solely relying on their existence. So you sort of stack your contracts with external and yours. Again, the intent here is to go back to Dan's point at the very, very beginning. We want the builder and developer margin opportunity together in that sort of structure. The structuring, as I said, is complex and it's no size fits all. So that does need appropriate time and planning up front. And source of capital, again, wouldn't be so much of a surprise, but you're starting to get to more of a self-funded or partially self-funded project here, with then help from the likes of NAB, etc., with sort of bridging any funding gaps to make projects possible. And of course, private capital still kicks around. Risk, yes, you have to be very careful. This is why Dan's coming around. You need to have some rock solid financial systems in place, because you are now centering the risk around yourself, because you haven't got any other parties. And so that also helps with, a discussion with Gus that we need to have some nice, clean financial metrics, structures, and a bit of history as well. We need to show there's a history of successfully doing this, because you need to convince the bank that you're not going to sink their funding on one project, that you've had a history of doing this well. And again, tax will come around in terms of how we structured through companies, trusts, and land tax from that perspective as well. Now, really quickly, this is just I won't call it a sort of necessarily a deep dive, but it's really us making a point that builder developers, it's very easy to just sort of mash it all together and lose sight of the builder part and the development part. Doing property development is likened to its own business. It just happens that there's a build component of it, right? So you need to look at it as seriously as you do your building company, and it's in its own business. It has inputs, being like the land, the cost of capital doing it, obviously the build contract, and then the ultimate profit. Also, as well, is with any of the building companies we're working with, particularly where a lot of the overheads of the building company are used for project managing developments, we need to make sure that we're structuring it properly, so those costs are being shared across the group. And this one's sort of a beware on how you structure this as well, in terms of how the funding is put together, particularly if not so much when you're using nice structured debt products with NAB, but if you're using private debt, etc., you can expect the interest rate is going to be horrible. And again, when you're structuring this debt, obviously as you're drawing down to do the build, obviously you're incurring interest. So just be careful how you're structuring the debt. And that's why we want to work with sort of nicer relationship managers like Gus and Julie, because the private funding game is not there to be a relationship. They're just to get an outcome and get money.
It's also something we see a lot of, which is also something to raise. The time that you would like funding is also important. There's a heap of transactions that I've done over my career, which has been involved with a private lender. So the private lenders have their place in the market to help you acquire the site potentially with, advantageous terms for approval. Maybe the cost is significantly higher, but it gets you there to win the project, to actually acquire the site. There's plenty of times where the bank funding, the major bank, which is numerous amount of percent lower, 3, 4, maybe 5, 6% lower. And then we do a refinance of the land loan and provide you with that build loan facility. It's actually one of the situations where private lenders and banks probably work most harmoniously together. As Josh mentioned, the private lender's there to make some return for their investors in a short period of time. And the bank's there to do a deal that gets a project completed once all of our metrics are met. So it's definitely a potential option as well. Just quickly giving you an update on this slide. I think ultimately for the individuals that we've got on the webinar today, we saw there was a large percentage of you in those sort of early stages of development. My personal preference and my thoughts on if I was going to be doing a development myself, you would want your trading business to be involved. It provides the serviceability for the loan. It also ensures that you've got the ability to complete the project. It doesn't mean that you don't have a joint venture partner, but instead of, I think either Josh or maybe Daniel mentioned before, no, it's not that you don't have any third-party clients anymore. Instead of doing 15 builds for all third-party, maybe you do 12 builds for third parties and you do 3 of your own in the first year or whatever it is. Because ultimately, the development itself, until it's sold and you find a buyer, you're not making any money. It's all opportunity cost that sits in there. And it's a conversation about, well, how much profit are we leaving on the table if we sell it? Or should we retain it? So these trading business projects are very similar to the joint venture, except that there is a business involved that we assess. We look at your financials, and in most situations, you're going to build it for yourself. So what Josh mentioned earlier about having a strong balance sheet, having a strong WIP, and being able to account for where the money goes on each project is extremely important in this situation, because what you're looking to explain to myself, and then I advocate on your behalf to my colleagues, and within my approval, we approve the deal, is our building business has a consistent level of finishes. We have a consistent level of completion. Why wouldn't we be able to do it for our own project? That's really the story that we're telling here. The benefit of having the trading business in there, it provides an income. So there's a mitigant where we might not have to do an interest capitalization model. So there are some loans that we provide the interest only, some you pay principal and interest repayments. Most developments, what developers like to do is have the interest cost deferred until the end of the project, and that way it's paid off with some of the sale proceeds. We're happy to do that. We do it often, but as I was talking about earlier, those mitigants around, well, how much equity is the customer putting into the project? Or Augustine, can we look to use the project site uplift value to borrow a bit more? Or is it possible to not sell 100% of the site upfront? Can we sell maybe 70%? All of those questions and those policy changes, the benefit of having the trading business is that we've got an income there to provide of risk mitigation, and it helps us get those requests across the line. That's really the benefit of the trading business. If anyone's got any other questions, put them in the chat. But a lot of what we talked about in the joint venture is applicable for this scenario.
We might, if it's okay, we're kind of up on time now, but we've got a little bit more content to do. What I didn't want to miss the opportunity. So we always, as part of these sessions, there's always a lot more to kind of unpack. And there's always very specific considerations that we've got to, look at when we're, providing answers to things. So if you want to have a one-on-one session with us after this, we'll get back in touch with you and set up a time that works. We can either do that on Teams, or you can come and see us, or a phone call, whatever the case might be. But just and this is multiple choice. If you want to talk to all of our divisions, we're happy to do that. If you want to talk to NAB, they're happy to have a chat as well. And this could be, just that next piece of that next layer down of information that you need, to help you as part of your decision making in this space. It might be that you're interested in, engaging on a particular deal right now. Wherever you're at in the journey, we're happy to do that as a one-on-one session. So I'm going to leave that just running while we just cover off on Josh, if you just want to do these final kind of do's and don'ts.
Yeah, do's and don'ts. I'll rip through this quickly. So the key things, as we've been saying all along, do upfront, talk to the right people, and think about all the elements that need to go into it upfront. Don't do it as an afterthought. So we need to be talking to Gus, Julie, financiers upfront, legal agreements, structures. To Dan's point, you must be job costing projects as a developer and a builder anyway. That's just a non-negotiable. Financial feasibility, which we'll get to in a second on the next slide. You need to be doing a project feasibility, not just for the build contract, but the actual project itself. For me, of course, get taxation advice. It's too complex to not do that up front. And particularly where you're playing in a space where you're doing resi or even commercial, I do say it is important to talk to real estate agents as well, because ultimately they will be the people probably selling your product. And so there's no point building a product in an area that you can't sell, but that sort of goes hand in hand, that if you're building a product that you really couldn't sell, probably you wouldn't get funding anyway because it wouldn't stack up. But you do need to make sure there's the right people around you. In terms of don'ts, it's all the things that you'd expect. Look, don't blend risk and assets together is what I'm saying here. So don't buy your development project in your building company. That's just like a 101. Don't do that. It's just blending risk and it's too dangerous. Don't assume things like each state in Australia has different rules around how land tax and stamp duty apply. So make sure that you don't just assume it's the same everywhere. And don't blend things together. Gus mentioned this before in some of these other areas, but don't underestimate the other elements that go into development. Surprise things around councils, infrastructure charges, all those sort of things that go into consultants, they can catch you out, which is why you must do financial feasibility. And again, don't wait till the end to see if you're making profit. And one key one that I get asked a lot is the last one here is, if I sell this property and make a big gain, if I just buy another project, does that mean I can offset the gain? It doesn't work that way. It's a bit more complex than that. And I'm happy to talk anyone through it. In terms of some really quick 2 tips, is when you're putting contracts together, think about some protection or flexibility clauses in those contracts, particularly around if you're trying to understand the structure of your deal. Obviously, you have to do it in concert with your funder, but you might use replacement buyer clauses, etc., as well, where things might change in the early phase. And the other thing is as well, if you're a developer that's going to actually land bank a bit, then there's a strategic way you can do that to sort of get the flexibility and reduce your tax. Phil, I think
I reckon. Yeah, what we're going to do, we were going to have actually, can you just share again, Josh? I might just get you to just do these final slides, if that's cool.
Yeah. No worries at all.
Gus and Julie were going to do a thing on equipment financing. What I'm going to do, though, I think because we're out of time, I'm inviting them to come back and do a mini webinar. We do these Xact mini webinars now, which are really short, bite-sized, single topic issues. And if it's okay, guys, I know you're on the spot, but I reckon it'd be good to come back and do that as a separate topic.
Yeah, of course. No problem.
So we'll just skip through those slides there. So then the final bit is we have a really good feasibility tool. If you just want to get to that one, Josh.
Well done.
Yeah. There's a section on our website, which is our resources section. And within that resources section, you can find all the different tools and tips, previous webinars that we've done, etc. You can search by topic. You can search by format. Like if you just want to see all our ebooks or all the webinars, you can do that. And so we've got a feasibility tool that you can use right at the beginning before you buy land, before you get involved in a project, to work out an estimate of what the financial picture of that project's going to look like. So we'll share that with you in the email afterwards. Coming up, if we can just get to that, Josh, so skip through a bunch of slides. We have another webinar coming in May. This one is on pricing labour. So it's one of the hardest things to get right in projects. Dan is going to be guest starring on that one. We're going to go through some formulas and calculator that we use around just really properly understanding the full extent of labour cost in a project, because we often see this as something that's either you're not factoring everything into that sort of hourly rate that you're putting into your estimate, and there are other factors involved in terms of how projects can have overruns and the like. So we're going to do a real deep dive on that one. That's another masterclass webinar that we'll be running 22nd of May. We'll send out invites ahead of time for that. We did have a few questions on there. There was a question there, Josh, around with the splitting the business and the builder and developer. Does that assist with QBCC reporting? Maybe if you want to just quickly speak to that one. We can probably stop sharing now as well, I reckon.
Stop sharing there. Does it assist with QBCC? It does, insofar as we're not counting development as part of QBCC revenue reporting, yes. But it's more of a risk mitigation is why we split it. We just don't want developments being jammed into that trading entity, particularly residential, where there's home warranty that applies. So it can help. Short answer is yes, but probably for a slightly different reason, because whilst it's an asset, it's not strategic to put it in the building company.
Yeah, Mark has asked a very specific technical question there. Mark, if you want to get back to us, we might unpack that further, unless, Josh, you want to go down that rabbit hole now.
Rapidly, and I'm going to answer it.
And there's one there around using BAS statements, basically low doc lines.
Quick answer to I think Darren asked that question. Look, ultimately, there are different ways that we do our financial assessment. What I would say is it really depends on the structure that you're looking to do, whether it's a trading business guarantee or a pure development facility. For the level of debt that you'd want to be getting into, like a lot of developments these days aren't getting off the ground for less than sort of 4 million, which is the cost of land. So it's probably not going to be an applicable product in our space at NAB. But if you're looking at lending sort of below that sort of 1.5, our colleagues in the small business team, that's their bread and butter. They do that all the time. And I've been at NAB for a long time. I used to be a small business banker back in the day, and I can give you some information on that as well.
Yeah, and I'm sure direct people as they need to be directed inside NAB too.
Yeah, 100%.
Josh.
Yeah, no, real quick one. I'm happy to talk to you, Mark, separately. But whilst it's not impossible, it is a very cautionary area, because what you're saying is a landholder entity, particularly if it's one entity, it's going to say some of the stuff we're going to do is for profit making now, and some of it's capital gains. It's a little bit tricky to prove both at the same time, and the onus of proof will be sitting on you when the ATO asks the question why you were doing it both ways in the same entity. So it just becomes much harder to justify. But that would be a very specific set of circumstances.
Yeah. And as I mentioned, happy to talk through any of those kind of specifics. Okay, I think we are well and truly out of time here. Thank you so much, Josh, Dan, Julie, and Gus for today. Hopefully, everyone's got a lot out of the session. We are sending, as I said, we're going to send this recording out to everyone and some resources as well. We'll also make that offer available as well. If you do want to reach out, we'll include a link for you to book a time with us as well in the email. Apart from that, there is a survey when you log off. Give us some feedback so we can keep improving these sessions, find out what else you want us to talk about. But yeah, go well out there. It's a good time to be in this industry. There's a lot happening, and we hope you make the most of it, and we hope to talk to you down the track. Thanks, everyone.
Thanks, everyone.
See you later.
Bye.